Credit rating agencies, understanding their role and controversies. Presentation overview. Credit rating agencies. Credit rating agencies are organizations that rate the creditworthiness of entities such as corporations and governments. They assign ratings based on a variety of factors, including financial strength, management quality, and market conditions. How credit rating agencies work. Credit rating agencies collect and analyze financial data on entities they rate, including financial statements and market trends. They assign ratings based on their analysis, which are used by investors to evaluate the risk associated with investing in a particular entity. Criticisms and controversies. Credit rating agencies have faced criticism and controversy over their ratings process, including conflicts of interest and inaccurate ratings. The 2008 financial crisis highlighted some of the issues with credit rating agencies and led to increased regulation and scrutiny. What are credit rating agencies? Definition and role. Credit rating agencies are companies that assess the creditworthiness of governments, corporations, and financial products. Their ratings are used by investors to evaluate the risk of default and make investment decisions. History and evolution. Credit rating agencies have a long history dating back to the early 20th century. They have evolved over time, adapting to changes in the financial industry and improving their methodologies for assessing creditworthiness. Impact on financial industry. Credit rating agencies have a significant impact on the financial industry, influencing the cost of borrowing for governments and corporations and affecting the pricing of financial products. However, they have also been criticized for their role in the 2008 financial crisis. How do credit rating agencies work? Credit ratings. Credit rating agencies assess the creditworthiness of entities such as governments and corporations by assigning ratings that reflect the entity's ability to repay its debts. Ratings factors. Credit rating agencies consider factors such as financial stability, economic growth, and political stability when assigning ratings to entities. Implications of ratings. Credit ratings have a significant impact on an entity's ability to borrow and investors' decisions. Lower ratings may result in higher borrowing costs and reduced investor confidence. Criticisms and controversies. Role in 2008 financial crisis. Credit rating agencies have been criticized for contributing to the 2008 financial crisis by giving high ratings to mortgage backed securities and other complex financial products that turned out to be risky investments. Conflict of interest. Credit rating agencies have been criticized for having a conflict of interest because they are paid by the same companies whose financial products they rate. The- This creates a potential bias in their ratings and undermines their objectivity. Rating methodologies. Credit rating agencies have been scrutinized for their rating methodologies, which are often seen as opaque and difficult for investors to understand. This has led to calls for greater transparency and accountability in how these agencies determine their ratings. History of credit rating agencies. Credit rating agencies have been around since the early 1900s when they started providing ratings to US government bonds. Over the years, they have evolved and expanded their services and become increasingly important in the global financial industry. Impacts of credit rating agencies. Importance of credit ratings. Credit ratings assigned by rating agencies are crucial for investors in evaluating the creditworthiness of an entity and making informed investment decisions. Impact on borrowing costs. Credit ratings have a significant impact on the entity's ability to borrow and the interest rates they pay. Higher ratings translate into lower borrowing costs and vice versa. Impact on financial markets. Credit ratings can influence the financial markets and credit spreads, leading to changes in the cost of borrowing and the availability of credit. Factors influencing ratings. Financial strength. Credit rating agencies consider a company's financial strength, including its balance sheet, cash flow, revenue growth, and profitability, when assigning ratings. A company with a strong financial position is more likely to receive a higher rating. Market position. Credit rating agencies also consider a company's market position, including its competitive landscape, market share, and growth prospects, when assigning ratings. A company with a strong market position is more likely to receive a higher rating. Regulatory environment. Credit rating agencies also consider the regulatory environment in which a company operates, including regulatory policies and oversight, when assigning ratings. A company operating in a favorable regulatory environment is more likely to receive a higher rating. Criticism for role in 2008 financial crisis. Credit rating agencies. Credit rating agencies have been criticized for their role in the 2008 financial crisis due to their inaccurate and inflated ratings of mortgage-backed securities. Inaccurate ratings. Credit rating agencies assigned high ratings to mortgage-backed securities that ultimately proved to be risky and led to the collapse of financial institutions during the 2008 financial crisis. Collapse of financial institutions. Inflated ratings of mortgage-backed securities by credit rating agencies played a significant role in the collapse of financial institutions during the 2008 financial crisis. Conflict of interest. Conflict of interest in credit rating agencies. Credit rating agencies are paid by the entities they are rating, leading to a potential conflict of interest. This means that the credit rating agencies may be incentivized to give inflated ratings to the entities in order to keep them as clients. Addressing the conflict of interest. To address the conflict of interest, the credit rating agencies have implemented various measures such as adopting codes of conduct, disclosing their methodologies, and establishing independent oversight committees. Implications for credibility. The conflict of interest in credit rating agencies has raised concerns about their credibility and the accuracy of their ratings. This has led to calls for greater transparency and accountability in the industry. Implications of ratings. Credit ratings. Credit ratings assigned by rating agencies can affect the entity's ability to borrow and investors' decisions. The ratings range from AAA to D and define the creditworthiness of the entity. Global economy. Credit ratings can affect the global economy by influencing the flow of capital and investment decisions. A downgrade of a country's credit rating can lead to higher borrowing costs and reduced investment, which can have a negative impact on the economy. Financial markets. Credit ratings can affect the financial markets by influencing the demand for securities and the pricing of bonds. For example, a downgrade of a company's credit rating can lead to a decline in the price of its bonds, which can affect the value of the portfolio. Conclusion. Role of credit rating agencies. Credit rating agencies play a critical role in the global financial industry, assessing the creditworthiness of different entities and providing investors with a measure of risk for investing in debt securities. Controversies and criticism. Credit rating agencies have faced criticism for their rating methodologies and conflicts of interest, which can raise questions about their objectivity and the accuracy of the ratings. Thank you.